All right, good afternoon, guys. My name is Stevenson Lindor, and I'm just doing this video, just a quick, short introduction into Forex Basic, which is the Forex market. I'm gonna go over, marking up your charts using simple, just support and resistance line. I'm gonna go over how to properly use risk management when entering orders. We're gonna go over three main stages of price movement, and like I said, we're gonna go over understanding forex trade sizes. All right, so real quick, what's the forex market? So the forex market, also known as FX, short for forex, is a global decentralized market for trading of currencies. Like the euro, US dollar, Japanese yen, on all different aspects of currencies in the world. Okay, so this includes buying, selling, and exchanging, like I said, all different currencies around the world. All right, it's by far the largest market in the world. We're talking about close, if not over, 5 trillion on a daily basis. Okay, now when trading the market, you need to understand that the market is just full of buyers and sellers. All right, that's exactly what the market is made up of, buyers and sellers. You got the bulls, you got the bears, and it's a everyday battle, tug of war of just price pushing up and down, up and down, up and down. That's all buyers and sellers do all day, every day. Now, what I'm going to show you guys is how just using simple support and resistance, or supply and demand zones, how you can make money on a daily basis, and I'm talking about realistic money. I'm talking about real world trading, not taking a small $100 account, flipping it to $1,000 in less than 24 hours. No, 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 no. That is not real trading. All right, I'm talking about a steady growth. I'm talking about increasing your account by 5–10%, probably on a weekly basis, monthly basis, and just building your account from there. The reality is, and what a lot of people don't tell you is, the forex market is rigged. Okay, the forex market is one of the hardest and most difficult market to really profit from. Over 90% of traders fail when trading the market. They lose their money. Why? Because they don't understand it. They don't realize that as soon as you open up an account, it's you as a retail trader versus these hedge funds, these large institutions around the world. All right, their job is to take your money. That is what they're supposed to do. Okay, and if you're really trying to take forex seriously, unless you're coming in with a real account and depositing at least minimum of $5–10,000, guys, you're not going to be as successful as you think, and what a lot of people are showing online, whether it's Instagram, Facebook. Can it be done? Yes. Have I done it? Yes. You can turn $100 into $1,000 in under a week. It has been done. It could be done. But for the new people out there, this is not a realistic goal. All right. And starting off with a $100–200 account, that's not real money. Okay. That's one of the things that a lot of people won't tell you. So I'm going to show you by, using just these basic tools, you can become profitable in the market. All right. So first things first is understanding buyers and sellers. All right. So that's exactly what the market is made up of. Now, as you can see, I have a clear screen here, and the green candle represents the buyers. The red candles represent the sellers, or the bears and the bulls. Okay. And like I said, the market is made up of three main stages. All right. Now, there's a trending stage, there's a consolidation stage, and then there's also a transitionary stage. Okay, so a trending stage is an uptrend stage. An uptrend is this right here. So you got the buyers pushing up price all the way up here. That's a trend. And then sellers taking control of the price and pushing it down. That's a trend. The consolidation trade is basically when price is moving sideways, or as in consolidation, it's just ranging. To get a better idea, right here, this all is consolidation. The market price is just ranging, bouncing up and down, up and down. It's not a pure trend. It's not going all the way up. It's not going all the way down. Okay, you want to, as a trader, you want to get in pure trends. You want to get in an uptrend, or you want to get in a downtrend. You want to kind of stay out of the consolidation trades. And then the trending, the transitionary stage is basically when the market drops or goes up, and then it kind of just reverses and go the opposite direction. Those are also what you want to be aware of. So like I stated before, you just want to make sure that you get in pure trends, which is a downtrend or an uptrend. All right, now I'm going to show you how to basically mark up your chart, where you're basically creating yourself a map, a guideline throughout the market, so you know that you know where you're always at, and you're just protecting yourself. Okay, so let's do that. Let me get rid of this. And for those who don't know, there's usually 9 time frames up here. Me, I only use 7. And the reason why I cut out the other 2 is because I think they're unnecessary, which is the 1 minute and 30 minute. But it's usually the 1 minute, 5 minute, 15, 30 minute, 1 hour, 4 hour, daily, weekly, then monthly. Okay. Now I look at the time frame as a book, because that's exactly what the market is. It's a book. It's a big book. And you must understand the entire book in order to trade successfully. All right. So I look at the 1 minute as a word in a book. I look at the 5 minute as a sentence in the book. And then I look all the way up to the monthly as the entire book. All right. That's how I'm going to understand. And the higher up time frame you go, the better idea you get of what that current pair is trying to do. All right. So right now I'm on the USD JPY pair. All right. Now, if you notice, I'm on the 5 minute. Once I click over to the 15 minute, look, the story completely changes. I move from the 15 to the 1 hour. The story completely changes. All right. Each time frame is telling its own story. So if you take a trade off the 1 hour, you can't expect immediate results on the 5 minute, because the 5 minute is telling a different story. All right. You got to be realistic. You got to understand which time frame you're operating off of, and when you're placing your trades, in order to get the exact results you're looking for. All right, so you must look at the higher time frames, preferably the weekly and daily, to understand where the market is trying to go. So I usually start off with the monthly just to see where I am, and I'm going to start from the beginning here, clear this all out. Weekly, and as we can see, so for the month, USD JPY has been on a downtrend. If you go back to the previous candlestick, shows clear downtrend. Boom. Now it's kind of basically hit a support. So so we got buyers basically kind of pushing price back up, letting them know like, hey, you've come down kind of enough here. It's kind of hit a breaking point, and buyers are trying to push price back up. So, but as of right now, USD JPY is on a downtrend. That's what the monthly time frame is showing us. If we work our way down to the weekly, boom, same thing. Based off of last week, it's on a downtrend. So now we're wondering, is USD JPY trying to shoot down, maybe possibly around the 109 range, or is it going to turn around and shoot up? Now, if you notice, based off the previous week's weekly candle frame, it's kind of basically in consolidation, which is what I've been talking about as far as what you don't want to really get yourself caught up in. So the last 4 or 5 weeks, it's just been ranging, jumping up and down. So it's been going between a range of 114, basically 115, all the way up here, and breaking down to a low of 110, 110, 600 range, probably 5. All right, so like that's the range for the last several weeks on the weekly chart of this. So me placing probably a support right here. You can probably see price shoot up a little bit before possibly coming back down and breaking through this price, because this is the support range right here. As you can see, prior to the previous wicks and lower candlesticks, it's trying to break through. So we'll see by this week if price is going to shoot down or it's going to reverse and go back up. Now, when I make my way down to the daily, then the story breaks up some more, and then now you can clearly see. So based off of last week, it was a clear downtrend, and then on Friday, as you can see there, it came back up. It was really an indecision candlestick because it's not a pure candle, but you can see it's a green. Buyers kind of took control right before the day ended. All right. So now I'm going to show you how to just mark up your higher time frames and how you can just create a map through the lower ones. All right. Now I usually operate off of just the weekly and the daily. All right, those two time frames to me are very critical. If you understand the weekly and the daily, I'm telling you, you will go far. All right, so just using support and resistance. That's what I'm going to do. So I recognize this is my bottom round here. All right, and if you notice, I placed them around the wick. Why? Because that's how far price went down. That's how far sellers pushed the price. All right, so support is basically below market price. Resistance is above market price. So support is basically being buyers trying to push price back up. Resistance is sellers trying to push price down. All right. So this would be the support, and I place it around the wick because that's how deep price went. So as you can see, based off of the last weekly candle, it went past it a little bit, but it never closed below it. And then buyers pushed it up a little bit, and then it ended the week above that support. So we're gonna see if basically this weekly candle, if it's gonna break through this support range that I placed here, which is like the 111, 106 range, break past it and continue down, or it's gonna bounce off of it and come back around. And I'm gonna place another line, and I'm gonna place it because this is the range, so I want to get the range of the last several weeks, and I'm gonna place resistance line up here. Now, usually what most traders do, they place it at the high top and low, but I'm not placing it up here because this is where price is. This is based off a higher time frame, the weekly. In order for price off the weekly to get back up here, it would take probably the rest of the year to get back up to like the 1, 2, 4 range. So I'm just gonna gather the last several weeks, just get it because it's been ranging, get it around there, and you're gonna see how it reflects in my lower time frames. Now I'll make my way down to the daily. Boom. As you can see, all these daily candle, because each candlestick represents that time frame, as you can see, it's respecting this support and resistance line that I've set. All right. So now this is, since the market opened back up, today is Sunday, this is a new candle that's being formed. We're going to see if it's going to drop or it's going to reverse and come back up. I'm going to place probably one more line. And how I know also to place lines, everything you need to know about the market, all you have to do is look left. That's one of the things that I've noticed. Everything that you need to know about the market in order to predict the future, all you have to do is look to the left. All right. The market's constantly repeating itself. There's nothing that's happened that it hasn't done before. You just got to figure out, what the market is doing, whether it's trying to go up or down, and not get caught up in the middle. Keep it simple. All right. So just based off the past, I can see, boom, got this edge right here, probably place, and I had to go back almost a year, place a line there, and then boom. See how that lined up? I had to go back a while to find the next breaking point, but that's what you got to do. You go here, this was a breaking point, you see that gap, I placed a support under there, and then when I zip through and look how far I had to go back, basically October 2014, when I come back here, look how it lines up. Now when I go down to my lower time frames, you're going to see how this all balances out. So now I'm in my lower time frame, like the 4-hour, which is one of the time frames I really like to operate off of, and boom. As you can already see, the market is already respecting these zones that I've created. All right. And that's what I want. I want basically a map of what's going on. All right. And I'm going to show you how to basically just trade off of the support and resistance line. Just this basic stuff alone will make you money, will keep you profitable. All right. The goal is to make consistent money on a consistent basis. All right, guys, it's not to become a multi-millionaire, billionaire in the next, couple of days, couple of weeks. All right. My job is not to make you rich. My job is to show you guys a better way of trading responsibly, and to keep you profitable. All right. If you follow these rules and these things that I'm about to show you, I'm telling you, you'll stay in the game longer. You'll be a profitable trader, and you can definitely make money. You can definitely make a living out of this, but you got to be realistic with yourself. All right. So how do you use just these zones, and how would you be able to just trade off of them? All right. So let's start from the beginning. So like I said, there's support and resistance. Support being buyers, resistance being sellers. So as you can see here, back in February, market price was coming down. Boom, boom, boom. Hit this support. It wasn't a real breakthrough. Now, when market price gets around your support and resistance line, what you're looking for is either a breakout or you're looking for reversal candles. All right. So a breakout basically means a strong confirmation, a strong candle through that support and resistance, and then continuing down, or you're looking for reversal candles where it like touches your support and resistance line and then reverses and go back up the opposite direction. All right. So right here, what the market price did, it touched several times, as you can see here, based off of this 4-hour candlestick. So we're talking about 4, 8, 12, 16, 20, 24, 28, 32. So we're talking about almost a day and a half, 36 hours before it finally just decided to say, hey, we're not going to go on an uptrend. And as you can see, a strong candlestick. So it broke down. This is not where you get in for your sell. This is where most people make a mistake. They get in and they think, like, if they got in for a sell here, they're lucky, because when the next candle formed, it continued the downtrend. I usually get in on the third one. And the reason being, because sometimes when that candle closes below that support and resistance, the next candle that's formed, it retraces back up. So 8 out of 10. So you got to be careful of that, because a lot of traders, what they'll do is, like, once they see market price gets around their support or resistance line, they'll jump in the trade and try to jump the gun. You don't want to jump the gun. Let the market do what it does. All right. Your job as a trader is to just follow the trend. Your job is not to correct it. It's not to tell it needs to go in this direction or that direction. Your only job is to follow the trend. Whatever the market does, you do. I can sit here all day and say, hey, I want, UJ to go up back to, 115. All right, that's fine. But if the market doesn't want to do that, then that's not what it's going to do. Your job is to follow the market, make money with it, not against it. All right. So you wait. It broke through, closed. You need confirmation. You want to wait that. You want to see that it actually stays here, because it could have broke through and then easily retraced back up and gone. So you wait till this 4-hour candle is up, closes, boom. After that 4-hour candle, you wait for the next one to form. If you see it's going on a downtrend, not really retracing back up, then you can get in a sell, and then boom, you can ride it all the way down. Now, as a trader, people always ask, well, how many pips are you looking for? How much money are you trying to stay, or what you're looking for, and so on and so forth. What I tell everybody is have goals based off your account and based off how much you're trying to build. I always tell people build off of pips and percentage. So let's say you have a $100 account and your goal is trying to build 10% per day, so which is $10. Then get the necessary pips you need to average your 10 bucks. All right. And I'm going to show you guys a good tool that you can utilize. It's called a Pip Calculator. Well, it does all of the calculations for you. It tells you how much is in your account, how much you're trying to risk, where you set your stop loss, and boom, and how much you would possibly lose or gain. All right. So back to this, I would enter my trade here, ride it out for a couple candles. So maybe, so since this is the 4-hour time frame, so I'm riding this out for 4, 8, so 12, about basically 12 hours, boom, get out the market around here and take my profit. All right, easy trade. Yeah, I could have rode it all the way down here, but I don't want to risk it. Don't want to be greedy. The goal is to make money, make as much as you can, maximize your profits, minimize your loss, and call it a day. All right, we're not here to fall in love with the market. Understand, like I said, the moment you enter a trade, these institutions, these market makers, these banks, hedge funds, so on and so forth, they're there to take your money. The broker you sign up with, whether it's Traders Way, TalentX, FXCM, whoever, their job is to take your money. All right, so don't be greedy. make your money, protect your profits, get in, get out. This is highway robbery. All right, that's exactly what this is. Okay, get in, get out. That's it. Call it a day. All right, so market price broke through, came down, then it hit this support level right here. It bounced off of it. Boom, you wait. You see how it closed? And then the next 4-hour candle, and you see what did it do? Boom, it retraced all the way back up because the market covered so much space. It just did a crazy downtrend, and then it came all the way back up. And then the market came, boom, broke through this previous support, which was support here, and now resistance, broke through that and came back over here. Now, if you notice something, every time the market price breaks through your new zone, because that's what this is. When you create this map of the support and resistance, you're creating zones. You're basically, like I said, you're creating yourself a map within the market. If you notice, so when market price like breaks here, if you get in a trade right here, you know you can ride it all the way down here because the market price is eventually going to make it. If it breaks through this support, you can ride it all the way down here. You're going to be in the trade for a while based off the 4-hour time frame, but you can realistically ride the trade all the way down here. What did it do when it got back here at the bottom? Came up, boom, broke through. You could ride the trade all the way up here and caught all these pips. All right, so these support and resistance, they're your friend, they're your zone. So you know when the market price is in these zones, you know it's going to hit the top, it's going to hit the bottom. So just by trading that alone, just by properly setting up and marking up your charts, you can just make money easy, just like that. It does it again. Came through, came around, broke through, boom. Would have got in here for a sell, even though it was a little bearish candle on that third candle, rode it all the way down here. And then did the same thing for a buy. Came back up here, broke up, came up, around. That's all market price does all day, every day. All right. Now, when entering orders, okay, you're entering your order up here to top left where it says new order. You would click on that. Now, volume. Actually, let me show you this right now. This is the Pip Calculator, which I was telling you about. Give me one moment. All right, now I already have it here. All you would have to do is go to myfxbook.com and write calculator, and then boom, this is the position calculator. So like I was saying before, based on your account size, you know what I mean? If you have like a small balance, which a lot of people do, they come in with only 100, 200, you know, 300 bucks, you're honestly only supposed to risk about between 1, maybe max 5%. So let's say you have you know, $200 account and you wanted to risk, let's say 5%. Boom, you put that in there. Your stop loss pips. So basically, if you go back here to your calculator, let's say you wanted to enter a trade, for example. Let's say you wanted to enter a trade around here. Boom, market price came back up, exploded. You wait for the next candle. You see it's going on a bullish run. You get in around here. People always ask, well, where do I place my stop loss? You place your stop loss based off the last candle, the last 1 or 2 candlesticks. So based off the last candlestick here, I see that the market price for that, the low was 112.602. So I'm placing my stop loss around this area. So it gives me enough wiggle room. So if I'm getting in here, which is like 113, 102, and I'm placing it around this range, you're talking about close to like a 70 pip stop loss around that range. All right. So when you go to your Pip calculator, boom, let's say you put that 70 pip, and this is all as an example. I'm not saying you do this for every single trade. And understand something, I'm trading off the higher time frame. I trade off the higher time frame. So this is the 4-hour. When you trade off the 1 hour, it's a totally different thing. So like if I got in here for that buy and I placed your stop loss is going to be much shorter. It's not going to be 70 pips. So let's say I got in here for my buy, and based off the previous 2 candlesticks, it's around here. So as we can see, we're only talking about, you know, 30 pips, 30 so pips. All right. So it's all based off the time frame you're also trading at. So the higher the time frame, the larger the stop loss is going to be. All right. But you also got to remember, if it's a large stop loss, you got to make sure that your account can handle it. All right, can withstand it. So, but let's say we're doing it off the 1 hour, right? Got in up here, it's a 30 pip stop loss. So I go over here, go to my pip calculator. So 30 pip instead of 70, boom, proper risk. Let's say we're doing Euro USD. You just calculate only one order, boom. You're only risking 10 bucks. All right. Why are you risking 10 bucks? Because that's your lot size. It tells you you're risking 5% of your $200 account. So boom, that's how many units. And let me just clear something up when it comes to lot, because a lot of people, misconstrue and don't use the proper verbiage when they're talking about lot sizes. The three main ones is there's a micro lot, there's a mini lot, and there's a standard lot. All right. So a micro lot is about 1,000 units, which is like 10 cents per pip. A mini lot is about 10,000 units, which is like $1 a pip, and a standard lot, which is about 100,000 units, which is actually $10 a pip. I hear a lot of people go, I turned a standard $1 into 500 bucks. No. That's incorrect. A standard lot is 100,000 units. It's actually $10 a pip. So that's why when you put in a standard on, let's say, a $100 account and it retraces 10 pips, remember, 10 pips, 10 times 10, that's 100 bucks. You just blew out your account. That's what I was telling you. You have to be aware of your account size when you're trading these accounts. A lot of people don't tell you is, yeah, they're flipping these small accounts, but they're over leveraging like crazy. Honestly, you're not supposed to be touching a standard lot until your account is like over $5,000. Honestly, like go ask any broker, any professional trader, they'll tell you. Until you have about like a few $1,000s, 5,000 preferably, and up, you're not supposed to be touching a standard lot. Okay, because that's $10 per pip. The market moves fast as hell. Like this is jumping up and down, up and down, up and down. This is rapidly. So every pip that you go down, you're going down about 10 bucks. And if you only have a small account, like your account can easily get blown just like that. So you got to be careful when, putting in these lot sizes. You got to understand what they mean. All right. So if you have a small account, your account leverage, if it's only 100, 200 bucks, it shouldn't be more than like I said, 1 to max 5%. All right. So you would enter it here. This is your best friend. This stop loss means everything. All right. I think it's more important than your take profit. All right. A great trader knows when to take a loss versus a bad trader. Bad trader will just sit in there and try to stick it out. No, minimize your loss, maximize your profits. Understand that you're not going to win every trade. I've never met a trader who's won every single trade. It's not going to happen. There's no system out, teacher or guru who's going to show it. It's not there. Okay, doesn't exist. Minimize your losses, maximize your profit. You put your stop loss here, put your take profit here based off the price, and you would execute. Now, there's also pending orders that you can use, and there's 4 different types of pending orders. All right, you have a buy limit, a sell limit, a buy stop, and a sell stop. All right. Now, what's a buy limit? A buy limit is when you place market price. You place this order below market price. So I would place, let's say the JPY is dropping. So I figure it to come up around this range. I'd place a buy limit here. Market price would hit my order, then come back around and go up. A sell limit is the exact opposite. Let's say this was on an uptrend. I place my order up here. The buy market price would hit my buy limit, activate it, and then I expect it to go down. That's a sell limit. So buy limit below market price. So while the market's in a downtrend, it's going to pick up that order, then reverse, and you expect it to go up. And then a sell limit, market is on an uptrend, it's going to hit that sell limit and then reverse and go on a downtrend. Now, a buy stop is when you place the pending order above market price. So if the market price is on an uptrend, it'll pick up that buy stop order and then continue on that uptrend. A sell stop is the exact opposite. Like right now, USD JPY is on a downtrend. So if I place a sell stop right here, it'll pick up that order and then continue going on a downtrend. All right. Now, be careful when placing these orders. Always understand where the market is going. I've seen people place pending orders and then it doesn't go in the direction that they expect. So make sure that when you're placing pending orders, you know that it's going to go in the direction that you think it's going to go. But other than that, it's a very good tool. Instead of sitting around and waiting for that market price to just hit that range, you can just put in a pending order. And so if I expect, you know, USD JPY to come around, let's say, you know, 111, 200 range, I can just put a pending order, place it there, and then boom. So like for a buy limit, I can do that right now. Since I expect that, there, come up for a buy limit and pending order. I gotta put my, let's say I wanted to risk cents, buy 200, and then I place my order. And then as you can see, my order is placed. So if the market price came down here, it would pick up that order, then come back around and expect it to go up on an uptrend. All right, so that's pending orders. Okay, guys. So once again, as far as marking up your charts, you want to look at the higher time frames. All right, you want to see what the current market is doing for the month. So for the current month, it's on a downtrend, clear downtrend. We see that, all right? Based off the previous candlestick, as you can see here, it's just been dropping, all right? I make my way down to the weekly because that's where I really want to mark it up, because remember, each candlestick represents that time frame. And the reason why I mark up my higher time frames, because those are stronger indicators. If I mark them up on the 5 minute, I still got, or the 5 minute or the 1 minute, I still got, you know, the 15, the 1 hour, the 4 hour, the daily. I got all those time frames that, you know, really direct and let you know where the market is going. So it's better and in your best interest to mark up the higher time frame so it reflects on the smaller ones. You mark up the smaller ones, they're not going to really reflect what's really happening on the higher time frames. All right. So get here, erased all this. Boom. So I'm placing my support below market price. This is where buyers will be, and I'm placing it by the wick. These wicks are going to become your best friend. You're going to love these wicks. If you notice, every time there's a wick, when the market is going up, when they hesitate or anything like that, like you see right here, for example, you see how it hesitates because it saw this wick here. All right, so that's like a price stoppage. Slow down, boom, next one came up, and then you got all these wicks. You're gonna notice they're gonna become your best friend. They're letting you know where price reach, where price is trying to go. All right, and the market price is always trying to reach a new high, a new low. That's why none of these candlesticks ever end up the same. If you notice, you'll never see a day candle and have the same number as the previous day candle. It can't happen. A new high and a new low always has to be done. So once you understand that, you'll always be in profit. Once you understand that a new low or new high is going to be that's going to be set, if you can just trade off the high and low off the previous day candle or the 4 hour or whatever time frame that you're trading, you'll always be in profit. Okay, so put my support here. I put my resistance above this range because this is the weekly time frame, so it's basically been ranging. So this is the high, this is the low. Boom. I make my way down to the daily. Put one more line here. Now remember, you want to look left in order to go right. All right. So boom. So I go left. I'm not marking these up because these are the highs all up here. The market price is down right now, so it'd be irrelevant for me to mark up here. So I'm looking for where price is. So as you can see, this is the nearest breakage point, this little gap right here. So I'm gonna put a line right here. Boom. And when I return, as you can see, it lines up. As I make my way down to the 4 hour, boom. Market price are respecting these zones, and you can literally just trade off these support and resistance. Make my way down to the 1 hour, boom. As you can see, boom. Market price broke through. Didn't close, but then market quickly retraced all the way back up. This is the example I was telling you about. This is why I don't get in the next candle, even though it closed above or below market price, your support or resistance. So right here, it broke through my support. I could have got in for a sell. Yeah, it dropped a little bit, but then it retraced all the way back up. So for all those sellers who got in, they got stomped out because this retraced all the way back up. That's why I usually wait for that third candle to form, because usually the second candle, sometimes it retraces back. So once I don't see it really trying to break down, it lets me know that it's trying to retrace. And then boom, came up, came back around. So now it's basically been ranging in this range for the last, day before it ended. Go based off the day candle, as you can see, just been ranging around this area. Now USD JPY looks to come back around. All right, so I just wanted to shoot this quick video, guys, just show you some basics, introduction to Forex. On the next video, I'll show you how to identify, double tops and double bottoms, also known as M's and W's, how I trade them, and, what's good confirmations. I'll also be going over more trend lines, marking up charts, and I'll show you guys how to use Fibonacci's. But for right now, just going over a little basics, went over orders, proper risk management. Remember, there's a Pip calculator that you guys can use. Go to myfxbook.com, Forex calculator, and utilize this, guys. This is a great tool. It'll help you manage your funds and account. Remember, this is not a get-rich-quick scheme. You want to build your account slow but steady. All right, steady and slow will always win the race. Okay, like don't look to become a millionaire overnight. Look to stay in the game. Look to last. This is a marathon, not a sprint. Okay, and just proper marking up. And also wanted to go over two more things that I could cover in this basics. Actually, I'll wait when I'm in my next trade, and I'll show you how to protect your profits and also cut your losses. But for right now, that's all. Thanks for all attending and watching this video. I hope it was helpful, and I'll see you next time.